Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
Okay, let's just get right into it. Peloton Interactive, ticker PTON, is currently trading right around $6.33. That gives us a market cap of, roughly $2.45 billion. We're looking at a stock that is, technically it's trying to find a floor. It's basing inside a 52-week range between 463 on the low end and 1025 on the high. But the recent price action, that tells a story. Just last week, January 13th, we saw this rally up to $7.02. It was on heavy volume to 16.5 million shares, but it just completely failed to hold. It faded hard. That right there is the textbook definition of selling into strength.
It's a bull trap. A classic bull trap, and that specific move, it perfectly frames the whole debate we're having today, the one that comes out of that January 2026 equity research report. We are looking at a company at a really, really precarious crossroads. The question is pretty binary. Is Peloton a deep value play, just primed for a massive re-rating because it's finally pivoted to making money? Or is it a value trap, where the stock looks cheap, sure, but the business itself is facing a permanent structural decline?
I get it. I understand why you'd frame it as a trap, especially given the history. The chart is ugly. I'm not going to dispute that. But my entire stance is that the market is just fundamentally mispricing the bankruptcy risk here. It's pricing Peloton as if it's a distressed asset in a liquidation spiral, but the data, the actual numbers, tell a completely different story. The shift to positive free cash flow, that changes the entire calculus. When you are generating cash, you control your own destiny. You aren't beholden to the bond market anymore. So the current valuation to me feels irrational because it's treating Peloton like some dying hardware maker, when the internals show it's becoming this disciplined, higher-margin subscription business.
See, I come at it from a completely different angle. You're sitting here celebrating the bottom line, which is fine, but you're ignoring the total erosion on the top line. You can't cut your way to growth. It just doesn't work. The report shows a 6% year-over-year revenue decline. In this kind of inflationary environment, a nominal drop in revenue means a massive contraction in real volume. You simply cannot shrink your way to a higher multiple in the long term. That failed rally at $7 wasn't noise. It was a signal that the big money just doesn't believe in the growth story. The addressable market has collapsed from, everyone to just a tiny niche of affluent exercisers.
Let's dig into the financials, though, because I think you're glossing over the single most critical metric in this entire Q1 FY 2026 report.
And which one is that?
The pivot to profitability. Look, we aren't just talking about adjusted EBITDA, although that came in strong at $118 million, beating estimates by nearly $18 million. I'm talking about free cash flow. Positive. $67 million.
It is a positive number, I'll grant you that.
It's not just a number, it's a categorical shift. For the last 3 years, the entire bear case, your case, was basically built on a liquidity crisis. The argument was that Peloton would burn through its cash, get crushed by its debt, and face a messy restructuring. That risk is now effectively off the table. They are self-funding. When you generate $67 million in free cash in what is seasonally a softer quarter, you aren't going bankrupt, period. Yet the stock is trading at these distressed levels. The market is lagging the reality of the balance sheet.
I'm sorry, but I just don't buy that solvency automatically equals shareholder value. Sure, they aren't going to file for Chapter 11 tomorrow, but look at the revenue line again. $551 million. That is a 6% drop. The normalization cycle that the bulls have been promising for, 2 years now? It looks a lot more like a permanent shrink. The report explicitly mentions that the total addressable market, the TAM, has reset. During the pandemic, the TAM was like anyone with a pulse and a credit card. Now, it is strictly affluent exercisers. That is a significantly smaller pond to fish in, and the competition in that pond is fierce.
But the quality of that revenue is better. They've shed the unprofitable users, the churn and burn hardware sales, and they are focusing on high-margin subscribers.
Quality doesn't pay the bills if the quantity keeps shrinking. And technically, you cannot ignore the momentum indicators. We are still in a death cross, right? The short-term 50-day moving average is below the long-term 200-day. The RSI is sitting at, what, 36.79? That doesn't scream bargain to me. It screams lack of institutional interest.
An RSI of 36 suggests it's oversold. But let's move on to the valuation, because this is where the disconnect is it's glaring. You cannot look at these multiples and tell me the market is being efficient.
Go on.
Peloton trades at approximately 1.1 times price to sales. 1.1. Now let's look at the peer group mentioned in the report. Planet Fitness, PLNT, trades at 6.5 times sales. Garmin, GRMN, is at 5.3 times sales. Even Lululemon, with its own inventory problems, is at 2.2.
Okay, you are comparing apples and carburetors there.
They're all in the consumer wellness and fitness space. If Peloton simply reverts to a 2 times multiple, which is still less than half of Garmin, the stock price literally doubles to $12. The market is treating PTON like it has the plague, while Planet Fitness is priced for, perfection.
That's a compelling argument on the surface, but we have to unpack why those multiples exist. Planet Fitness trades at a premium because it's a franchise model.
Which means what?
It means the economics are fundamentally superior. In a franchise model, the local guy pays the capex to build the gym, buy the equipment, staff the front desk. Planet Fitness Corporate just sits back and collects royalties. It is high margin, predictable cash flow with very low capital intensity. Peloton is the exact opposite. They are capital intensive. They have inventory risk, they have logistics, shipping, they have to manage the whole hardware life cycle. The market pays at premium for the safety and predictability of a franchise royalty stream. It's that simple.
But Peloton has spent 2 years pivoting away from that intensity. They've outsourced manufacturing. They've streamlined logistics.
Managed it, maybe, but not eliminated it. And look at Garmin. You mentioned them at 5.3 times sales. Garmin is what we call a compounder. They are diversified. They have aviation, marine, outdoor, fitness, and automotive. So if the fitness craze dies down, Garmin still sells avionics to Boeing. If the economy tanks, they still sell marine GPS to boaters. Peloton has single vertical risk. If people stop biking at home, the company crashes. There is no hedge. The market applies a discount to that lack of diversification.
I think you're undervaluing the subscription aspect of Peloton. The hardware is just the Trojan horse. But let's talk about how they changed that narrative. Because a cheap stock can stay cheap forever without a catalyst.
Right, and the report highlights 2 main things here. The cross-training series hardware refresh and this Peloton IQ.
Exactly. And this is where the new leadership comes in. Peter Stern, the new CEO. He's ex-Apple, ex-Ford. He is a subscription services expert.
He understands the theory, sure.
He understands how to bundle and sell software. At Apple, he was instrumental in Apple One. He gets that the value is in the software ecosystem, not the metal frame.
But can he execute that at Peloton?
Well, look at Peloton IQ. This is the integration of AI and computer vision, using the camera on the device to count reps, correct your form, track your range of motion. It turns the bike or the tread into a personal trainer. This isn't just a gimmick, it seriously increases switching costs. If your bike knows exactly how strong you are, tracks your progress, coaches you, you are not going to cancel your subscription to go join a Planet Fitness where you're completely on your own. It deepens the moat significantly.
I see why you'd think that, but let me give you a different perspective. Rep counting is table stakes in 2026. Every fitness app on the iPhone does this. Tonal does this. Smart mirrors do this. Is it really a moat? And there's a massive privacy angle here. Do people really want a camera on their exercise bike watching them in their living room?
If it gives them a better workout and prevents injury, yes, they do.
Maybe. But the hardware refresh itself, the cross-training series, is getting mixed reviews. The report notes that while the swivel screen is nice, legacy users aren't exactly rushing to upgrade. Why spend $2,500 on a new machine if the old one works fine? And more concerningly, there are reports of technical glitches, screen failures on the new treads. In a turnaround, your execution has to be flawless. Hardware defects kill momentum and they blow up your gross margins with warranty costs. If Stern can't ship a perfect product, the software doesn't matter.
Every hardware launch has teething issues. I'm focusing on the strategic intent. They're moving from cardio only to holistic wellness. That matches the macro trend. But I want to pivot to the market microstructure, because for a trader, This is the most exciting part of the report. The fundamentals are one thing, but the positioning is a whole other story.
You're talking about the coiled spring theory.
I am. Look at the data. Short interest is approximately 16.6% of the float. That is a very crowded trade. But the key metric is the days to cover. It's currently sitting at 6.58.
For the listeners who don't watch that metric daily, let's just explain why that matters.
Days to cover calculates how long it would take for all the short sellers to buy back their shares, just based on average daily trading volume. Anything above 5 is generally considered the danger zone for bears. At 6.58, it implies that if the shorts all try to exit at once, there isn't enough liquidity to let them out. It would take nearly 7 full days of normal buying to clear the deck. So if we get one piece of good news, a buyout rumor, a solid earnings beat, liquidity vanishes, the price gaps up, margin calls hit, and the shorts are forced to buy at any price. That is a recipe for a massive squeeze. The powder keg is lit.
That is one interpretation, but I look at that same liquidity data and I see something, darker. I look at that short interest combined with the dark pool activity.
The off-exchange volume?
Yes, over 42% of Peloton's volume is happening off-exchange in dark pools.
Which usually implies institutional activity.
It implies that big money is hiding its tracks. But think about this setup. When you see high short interest and high dark pool volume while the price is stagnating or dropping, it often suggests smart money is distributing. They are selling into any retail buying liquidity they can find without crashing the public price. If this were a true accumulation phase by institutions, if they believed in the turnaround, we'd likely see more aggressive buying on the open market to push the price up. To me, this looks like institutions are betting on failure, or at least hedging against it heavily. They are keeping the price pinned down.
I disagree. I think the dark pool volume is masking the accumulation. Institutions buy quietly before they buy loudly. But speaking of ownership, we do need to address the insider situation.
We do, and it is not inspiring.
I know what you're going to say. You're going to look at the selling. Keter Stearns sold shares in early January. The CFO sold shares. But you have to look at the filing codes. The report is explicit. Those were sell to cover transactions for taxes on their stock units. That is non-discretionary. It's just noise. It is not a signal that he lacks confidence.
Granted, the tax selling is standard. I'm not worried about that. I'm worried about the aggregate ownership. Insiders own roughly 1% of the company. 1%.
It's a mature public company. That's not that unusual.
Here, they're hired guns. And while they had these preset 10b5-1 trading plans, they are consistently selling. If they really believed the stock was a deep value double just waiting to happen, wouldn't we see some open market buying? Why isn't Stern writing a check to buy shares at $6? We aren't seeing it.
They're incentivized by performance-based comp. Stern's package is tied to stock recovery. But I want to step back and look at the macro picture, specifically through the lens of prediction markets. We usually check Polymarket for these things to see what the crowd is thinking.
Interestingly, the report notes there is no direct high-volume prediction market for PTON stock price right now. Regulatory constraints on security-based swaps keep that activity low.
Right, but we can look at correlations. The macro-thematic markets. PTON is highly sensitive to the health of the consumer.
Exactly. PTON is a luxury discretionary good. So, if you look at the U.S. recession 2026 markets, there is a clear inverse correlation. If the odds of a recession go up, PTON is in trouble because churn will spike. People cancel the $44 subscription long before they cancel Netflix.
Conversely, look at the Fed rate cuts markets. PTON correlates positively there. Lower rates mean cheaper financing for the hardware. Most people finance that $2,000 bike. If rates come down, the effective monthly payment for the consumer drops, and adoption goes up. The prediction markets favor cuts in 2026, which is a tailwind the equity market hasn't priced in yet.
There's also the bankruptcy count markets on platforms like Kalshi. PTON used to be a favorite on those zombie company lists. The fact that they hit positive free cash flow likely removes them from that conversation for now. The wisdom of the crowd says they survive.
Which supports my whole thesis. Survival was the first hurdle,
Now it's just about valuation.
Survival is necessary, but it's not sufficient for a good investment.
So let's wrap this up. How do you summarize a situation?
For me, I view Peloton as a show-me story. It is a trading vehicle, not an investment right now. The stock is trapped below that $7 resistance level we talked about at the top. Until they can prove that revenue growth can return, not just cost-cutting, but actual top-line growth, I think the upside is capped. The macro headwinds from interest rates and the competitive pressure from actual gyms are just too strong.
And I see it as the ultimate asymmetric trade. The downside is capped because they are generating cash. They're not going to zero. But the upside, if they simply stabilize revenue, just flatline it, the multiple expansion alone gets you to $12. And the days to cover metric suggests any spark could cause a massive squeeze. The risk-reward is heavily skewed to the upside.
It's a classic battle between the balance sheet and the income statement. You like the cash flow, I hate the revenue decline.
And that's the beauty of the market. The Q1 report changed the narrative from survival to valuation, but we clearly disagree on where that valuation eventually settles.
We do. Is a 1.1 times multiple a gift, or is it a warning sign?
That is for the market to decide.
And for our listeners to figure out.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.